Welcome to the live stream. It is Friday. We've got about an hour to go of trading. I thought it'd be interesting to live stream while the market was active. We'll close this market out for the week, see how we do overall. We'll stream a little after the market closes as well. This week, the market has been grinding higher, just grinding away, going up. For the week, we have seen the market really go up nicely, about 1%, but again, it's grinding. It's not like just jumping up, kind of making it look easy. No, it's kind of been mixed. Some stocks going up, some stocks going down. That's why I'm referring to it as a nice grind upward. And when you look at the year to date, you see that the rally is kind of getting a little shallow in the trajectory. It's not just flying up, it's going up just nice and smooth. From a graph perspective, on a day-to-day, you see what's going up or down, and you see that it's mixed. Some stocks are going up, some stocks are going down, some stocks are falling behind a bit, some stocks are moving ahead a little bit, but nothing like outrageous. When you see Google, we're going to take a look at Google because they announced their earnings this week. And overall, the story's, I think, pretty good with Google overall. And it's good to see that they have held the rally that they experienced after their earnings and are actually rallying up today, which is good. Some other stocks that are doing better, Tesla's trying to recover some of the losses they had after their earnings. The healthcare space, man, they needed a break. They're getting a break today. Good, man. They deserve it. Looks like Kevin is in from Lakeland, Florida. Great to have you. Thanks for joining. Appreciate it. Hopefully you're having a nice afternoon. So yeah, it's a mixed bag. And when we kind of pull away a little bit and we say, okay, what's happened over the last week? Let's look at the heat map. Again, Google's had a good week. Amazon's had a good week. Some stocks have had a terrible week. Texas Instruments, terrible week. Intel, terrible week. IBM, not a good week. Netflix, not a good week. So some spaces have really been a step backwards for investors, and some stocks have been quite good. So Meta's had a decent week. Lilly's had a decent week. So some stocks are moving up, some stocks are moving down. When we move away from the 1 week, let's go over the 1 month. What has been doing well in the month of July? Similar theme. Now, NVIDIA has been somewhat unstoppable. Last month, 17%. It's up nicely for the whole year. It's the #1 most expensive stock on the market. It's valued the most. So that's doing great. Broadcom up. AMD's doing great. Had a great month. Some financials had a great month. Citibank up 18%. Nicely done. That's one that I own, so I'm glad. Google up almost 16%. That I take notice because Google's been lagging this year. Google's has just such a great business, but there's been stories out there that are doubting Google's future. The present, which is represented by financial statements, looks terrific. They grew in the quarter 14%, very profitable. They're investing a lot more in their data center for their AI business, as well as their clients, their customers that use their cloud. They need that infrastructure. So those are good things because their cloud business is really growing fast. So Google had a nice week. Microsoft had a decent week. Apple had a decent week. Amazon had a good week, up 9%. Hey, that's pretty good. And I think part of it is when Google announced that their data center is growing that fast, or I should say their cloud business is growing really fast, that sparked interest in Amazon, which has the biggest cloud business in the market, and then Microsoft, which has a cloud business that's also gigantic. So those two stocks really benefited. In industrials, the energy producers did great for the last month. Looks like Chevron had a decent month. Good to see. And some other stocks, they did well. So it's about picking the right stocks and taking the elevator up instead of the elevator down. Netflix did not have a good month. Berkshire Hathaway did not have a good month. And Berkshire has not had a very good run after Warren Buffett announced that, hey, he was going to turn things over to his successor. Ever since then, very beginning of May, this stock's down. So Berkshire Hathaway, it's just not going away. The whole premium of having Warren Buffett behind Berkshire Hathaway, that premium is pretty much getting out of the stock. Investors are moving out of Berkshire because it doesn't have that attraction of one of the legendary investors is behind Berkshire Hathaway. Now it's a new manager, and I'm sure he's going to do a great job. It's just not Warren Buffett. Asset managers are doing great. No surprise. We have a market that's really booming. And why is the market grinding higher, even though we're at all-time highs? Well, the theory that I believe is when you had this sell-off, retail investors like yours truly and other investors that are probably watching this stream, we jumped in head first. Hey, you're going to discount stocks, you're going to discount companies I want to own, I'll buy them. So we jumped in head first and just felt like it was an opportunity. It wasn't a time to be complacent and scared. And we were right. The smart money, these big professional investors, they did not. They were like, oh, those dummies, those retail investors, they're going to lose all their money. Really? Well, those dumb retail investors are making a lot of money, up 28% since the bottom. And I track super investors just to see, are these guys really that good? But in some cases, they're doing terrific, like Tom Lee. But even the great Warren Buffett is up only 0.69% when the S&P is up almost 9%. This is the great Warren Buffett. David Einhorn is terrific. Total respect for this guy, down 0.77. Pat Dorsey, geez, I've read his books. I think the guy's brilliant. He's down 9%. So when anybody puts it out there that, hey, there's smart money and dumb money, I'll listen to most intelligent conversations, but let's just be realistic. These guys carry a really big name, but their performance isn't getting it done. And you can go year after year, and you can see that for several years, some of these guys have just lagged the market. So if investors are hiring one of these guys to manage their money, it's two negatives. One, they're underperforming the market. Two, they have to pay somebody to underperform the market. No, thank you. That's why I did away with a wealth manager. I did away with, across the board mutual funds. I'd rather invest in the companies that I believe in, use my knowledge, experience, use my investing process, and invest individually in stocks and outperform the market. So this year is a really good example showing that, hey, individual investors, many of which are going to be on this channel, we're getting it done. And we're smart to take our portfolios and really be in control of our destiny and control the companies we're going to own, when we buy, when we sell, as opposed to relying on somebody else to do that for us. We get smarter and better over time when we do that. So the S&P is grinding higher over the past week, up 1%. Today it's up 0.46%. Nothing like, no big jumps of 2%. Like, that's when it kind of looks a little too easy, when stocks just fly up. This way, it's just a grind higher. So that's what's going on with the market. When we look at some earnings, we had earnings this past week from a lot of big companies. Starting on Wednesday, we had Google, Tesla. We can take a peek at those two stocks and see how they're trading after they announced their earnings. And some other big companies are out there, but it's just too many to name. And then on Thursday, we had Blackstone, a bunch of other companies. Friday, today, we had a couple companies, not too many of them. Next week is huge. We have 4 of the biggest companies in the stock market that are going to announce. We have on Wednesday, Microsoft, Meta. Those are the biggies. Of course, you have a bunch of other companies too. Thursday, Apple, Amazon. These guys are after the close, so we pretty much are going to see this spill into August. We'll see them report, and then we could see how their stocks move, and the next day of trading will be August 1st. So that'll spill into August. So it's going to be a big week next week. This week was big, but I think the market is grinding higher. Explain that probably because these big investors are finally getting into stocks that they believe in, like Google, like the others I pointed out. Amazon is another example, Microsoft. And next week could move us higher, substantially, because if these companies come out and they come out like Google, frankly, Google's earnings were really good. They grew by 14%. They expanded their profitability on the bottom line for earnings per share much more than investors were expecting. They have terrific businesses. So if Microsoft, Meta, Amazon, and Apple match the type of positive and enthusiasm that Google had, we're going to go higher. It's just too much good stuff to keep the market lower. And I think those big investors that have been on the sidelines, their error, they're going to have to jump into this market, because they'll have to explain to their investors, this is why I'm not in Microsoft. It's going up higher and you're not benefiting from it, because that hedge fund manager or fund manager made the decision not to be in Microsoft, Meta, Amazon, or Google, to put a couple of examples out there. So it's going to be a nice active week next week. We'll take a look at those 4 stocks and see how they're looking. We'll look at their valuations and see if I think they're going to be moving higher or lower. So I got a list of stocks I want to go over. If you're a member of the channel, a paid member, feel free to put a ticker in the chat. I can go over that ticker. We'll do an intrinsic analysis if it applies. If it just looks like a loser, I don't want to spend a whole lot of time there. But if it looks like interesting, we'll do a full analysis. We'll do a net present value of cash flows. We'll do a present value of what their earnings are worth. And we'll see and compare it against its current stock price. I'm a believer that in the short term, the stock market acts as a voting machine, a popularity contest. You have businesses that are super popular and investors are like, oh, I just want to own such and such because it's a great company. Haven't done any other analysis, any other research, but I just think they're a cool company. That's a voting machine. That's a popularity contest. But over the long haul, stocks are a weighing machine. And to give you an example of that, when we look at the most valuable companies on the stock market, NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta, and you look at their financials, you're going to see high free cash flows. And if you weigh the value of those cash flows, you get to valuations that are in this area. When you weigh the profits these companies produce, you get these valuations. And part of that is their growth rates. If you expect the company is going to grow in the future, they're going to grow the amount of cash they're going to produce. They're going to grow the profits. So it creates these $4 billion, trillion dollar valuations, $3.8 trillion valuation, $3.2 trillion valuations, and so forth. Study the big caps because they tell you the recipe that we're looking for in small caps. We're looking for growth. We're looking for the ability for that company to be highly profitable. That is part looking at the gross margin and seeing how they could really, as they become bigger, take advantage of that high gross margin and really drive profit and free cash flows. Those free cash flows are really important for my type of investing, which is I want to buy the next Amazon that is currently a small cap. That's what I'm searching for when we go after small caps and even medium caps. So that particular valuation strategy and I would say philosophy is consistent whether the company is $1 billion in revenue or $100 billion in revenue. Be consistent in that particular process. Keep your process consistent. That way you know what worked, what didn't, and you can get better over time. So we'll do that across some stocks. Mike, it looks like you're on. Started a small position of FinV. And Looking at EVTL, that'd be interesting to take a look at. So we'll look at FinV, which I have valued, and then EVTL. EVTL. Take a look at that high growth stock. Glad to do it. Rico Rocon. Good afternoon. Rainy Barcelona. Oh man, interesting. Well, good day to watch a live stream if you can't be outside. All right, guys, let's jump into this. Let's go over some stocks. Got it, Mike. Thanks for the heads up on EVTL. All right, so just to get the juices flowing, I'm going to go over Alphabet, and then we'll go. Maybe we'll go Alphabet, and then we'll go into Tesla, and then we'll cover these stocks that Mike brought up, FinV and EVTL. So the good news about Alphabet is that they are on a nice upward trajectory. If you look at the last month, they have been lagging over the past year. Now, it's not about where they've been, it's where they're going. And I think the right trajectory is upon this stock. I think it's going to keep moving higher because the fundamentals were terrific. Now, this is what we're hearing right now. You hear stories that, hey, with AI and AI applications and AI companies communicating that they want to create their own browser, I think it communicates a couple of things. Is first, Google has dominance with the Chrome browser. It's the most used browser. So their competitors, they don't want everybody to use Chrome because it almost is, you got to go to your competitor's backyard to run your app. So they're creating new browsers. And some people would feel like it's a threat. I acknowledge it could be a threat, but not at this point. I mean, Chrome is pretty dominant. Google spent a long time introducing Chrome a long time ago, and then beating out our friends over at Microsoft for the dominant browser business. And it's even more dominant than Safari on iPhone. It's just a really good browser. And that story is out there that, hey, is the browser going to be disrupted? Second thing is search. And search, is it going to be disrupted by these new AI apps? Potentially it can be. But at the same time, Google is putting out their AI business, and I think their AI applications are pretty darn good. And they just have so many users deploying or introducing their AI applications. They have a huge advantage. If you think about like an OpenAI or Perplexity or any of those guys have to do it the hard way, which is organic growth in users, where Alphabet has the luxury of just converting current users from what they have been using successfully, happily, trusting the Google brand for 10 years plus, just saying, oh, I can use the browser and now I have this AI capability. I think that's far easier than organically getting people to your website. They've never heard of you. You're a smaller business and trying to compete against Google. So I think overall, Google's in a good place, and their financials communicate to me that they are really operating well. Their growth actually increased, or I should say accelerated, in the most recent quarter, up to almost 14%. They are almost $100 billion per quarter business. They're at $96.4 billion of revenue. These guys are huge, and they drive terrific free cash flow. And that free cash flow is going to enable them to invest further into the AI businesses and be a big player in how people around the world interact with systems or AI applications or browsers or the internet. Alphabet will be a player. This cash flow is going to enable them to go after what they deem to be the best businesses that Alphabet can have. So that is a terrific number. The growth, I think, is what was great news. If they're growing, the most important information that a company will report is on their financial statements. Their financial statements cannot be exaggerated. The numbers have to be accurate, or a lot of people at Google Alphabet would be in trouble. they would be in a lot of trouble. Now, a CEO can sell their stock and just say out loud, like in a presentation, or maybe they go on an interview, and they communicate their enthusiasm about a stock and how they want to grow the business and so forth. But that's outside the financial statements. They can say whatever they want. That information I don't take to heart, because a CEO should be selling their stock, should be selling their company. They should be a fan of the company, or they shouldn't be CEO. The financials is where I get my information. That has to be accurate. Or executives, really well-paid people, get in a lot of trouble, they get let go. And if it gets really bad, if they really purposely mislead investors, they could be sued, or even worse, it could be a crime to defraud investors. So financial data in the financial statements is the information I take because it's the most accurate, and companies are accountable to those numbers. So all these stories about, hey, OpenAI is going to take over some business from Google Alphabet, it's a story. Could it happen? It can. Is it going to happen? Probably not. But what's happening right now, I have facts to support that the Google business is doing great. Almost 14% growth rate in the quarter. That's a sign of a great business that's getting greater, bigger, stronger. When we look at the stock and look at the RSI, it's at 73.6, and that's very good news. Even though above 70 means that the stock is overbought, there's just been too much buying of the stock. It shows that Google is now being bought by a lot of investors. It's really expanding. The investors that are more comfortable with the story behind Google are beginning to not listen to the press that loves to jump on negative stories and then dogpile, which I felt a little bit of with Google Alphabet. Just bad story after bad story, concern after concern. And the RSI showing a 73.6 shows that there's a lot of investors going into Google. So that's all really good news to me. Really good news. They pay a tiny dividend, by the way. Nothing to really, it's not for a income investor for sure. Cash flows look good. So when I look at Google and I do my own valuation of the company, I still have a discount on Google, and I'll show that to you. I still think the stock's discounted by 31%. Even though the stock's moved up nicely over the last month, year to date, it's only up a couple points. So it's still a really good buy in my book. As the stock sells off, I'm probably going to be buying, although I'm kind of being careful not to invest too fast. I feel like we've been grinding higher, but we're a couple negative stories from this stock selling off 5-10% as a whole. And I'd rather have lots of cash ready for that moment. So I'm slowing my buying, just being careful. But Google overall, I know it's a stock that in the community we've talked about at length. I know Tomas just joined. How you doing, Tomas? And the Tomas probably on an investor call asked me, hey, what do you think of Google? What do you think of Meta? And I like them both, by the way, but I think he asked for me to say, give him an answer. And the answer I gave him was, if I can only buy one or the other, it would be Google, because I just think they're misunderstood. And I think they're going to really, the market's going to come to that conclusion and then consistently buy into Google. And I think they're going to consistently go up from this point. And so far, I think I made that statement a month ago. So far, so good. I think that's the case with Google Alphabet. The same thing plagued Meta not too long ago, a couple of years ago. And Meta, the market really looked at the Meta business when they tried to go after the metaverse, and maybe that was a bad idea and a bad business, and they spent a lot of money into it. But for Pete's sake, the market just got completely, irrational to the negative side on Meta, saying, oh, that business is terrible. We don't care that Facebook is the #1 social app. We don't care that Instagram is just a money-making operation. We don't care that WhatsApp has billions of users worldwide. Well, I cared and I bought the stock, and that stock's just really flourished. This was a misunderstanding. The market didn't pay attention to the right facts and figures, and they just badmouthed this company. Well, that's a little bit in a different way. It's a little bit what I think Google has been dealing with. I think Google has been dealing with a lot of stories. I think some of it was that I think the culture at Google has been that they come out with great technologies. They're almost like they let their actions kind of speak for the company. They're not out there selling the company every time, every chance they get. No, they pretty much come out and say, okay, we want to go over, we want to go after robotaxi. They're number one in robotaxi. I mean, that's great. They're number one in robotaxi. Nobody talks out loud about that. Like, wow. And how far ahead are they? They're way ahead of everybody else in the United States. So that's another example of Google. So this stock really sold off recently by 29.4%. And you can see if you look at the 5-year, it really hasn't done much since April 26, 2024. It's only up 12%. You've seen it's gone sideways while some other stocks have just really flourished. So I think this one here has been misunderstood. If they just keep doing what they're doing, which is their fundamentals on their income statement, on their balance sheet, on their cash flow statement, continue to show evidence that these guys are just doing great. Their businesses are growing. I'm just going to keep buying Google because I think other investors are waking up to the fact that this is a good opportunity. When you look at the PE ratios for the biggest, most valuable companies, Google is at 20.5. That's much lower than NVIDIA, who's at 56, Microsoft at 39, Apple, who can't grow. They can't grow at all. They're at 33. What are they doing at 33? They should be at a 20. Amazon's at 37, Meta's at 28, Broadcom 109. Get your head around that number. So when you look at Google compared to the other big techs, that's a pretty good buy. It shows that, hey, we could probably see a March to 25 PE, and that would represent about a 20% increase in the stock price. So I think that's going to happen in 2025, and I'm glad that I owned Google. So good to see you, Tomas. How to resist the temptation of selling Meta? Buy back when it goes down. Oh, buddy, that is, I am not selling one share of Meta. Not doing it. Not doing it. Let me tell you why. Because I just don't want to be on the wrong side of this one. There's a couple businesses that are sitting there that have the keys to the future. They own a big part of the future. Meta's one of them. The year to date on this stock, 22%. 1 year, 54%. Now, this stock has flourished. As mentioned earlier, this stock has just killed it, right? Since the low point it had back in 2022, this stock has just been a rocket ship ride, 686% from the very bottom to the very top where we're at. But these guys own a big part of the future. Let me explain. Every month, over 4 billion human beings on Earth log into a Meta application. It could be Facebook, it could be Instagram, WhatsApp, Threads. It could be all four. Like I use all four. Okay. Some people are like me, they use all four Facebook apps. Super sticky too. Like Facebook, my family's all over it. I got to be on Facebook to keep up with my family. Some of my family is all over WhatsApp. Instagram is a favorite to friends and family, just all over the place. Having said that, when we look at what's next in technology, obviously AI is what's next, and experiences around AI are going to be all over the place. Experiences for professional life, if you're an attorney and you need to use AI to maybe search for some cases or some history around a particular law and some cases that have been handled, AI is probably going to be a terrific app there. If you're an engineer looking for engineering data, all those things are going to apply. Personally, I think people are also going to look for information that would help them maybe with mental health, maybe with health, on their own. Maybe they research a particular condition they have. It'd be great. So all those things apply. Now, a good jumping off point for people to use an AI app will be one of these Meta applications, and Meta AI is pretty darn good. It's getting better. Meta's putting a ton of money into it, and they're hiring people. They're hiring people away from Meta AI, OpenAI, and so I think if Meta is able to take a big share of users for AI and user traffic for AI, and then be able to monetize that and then have one more business that they can then monetize and sell advertising on. It's great. And they already have their awesome businesses, Facebook, Amazon, Instagram, Threads, and WhatsApp. They're beginning to monetize WhatsApp. It's an application they weren't monetizing a whole lot in the past. I know they had the data. Now they're beginning to monetize on WhatsApp. So I'm expecting that Meta is going to have a great earnings report next week. And I think Meta, this is $1,000 stock all day long. And they have just the right business at the right time. They have the right leadership, and they are pouring money into their AI business. And they should be very happy they're doing that. I think the stock is worth $1,073.43. I think we're 33% away from that stock reaching that level. How do I get there? Well, I get there by looking at their cash flows, weighing the value of their cash flows as they, work in their business. And when I discount those cash flows to today's value, I get a $3.2 trillion valuation for those cash flows. It's a lot of value, but the cash is there. I look at their statement of cash flows. These are not made up numbers. And then I, set up a forecast based on their cash flows. And then I project out what their cash flows are going to be. I discount at a rational discount rate of 8%. And that is the weight of their cash flow value in today's dollars. So Meta, I'm not selling one share. It's the biggest stock in my portfolio by a pretty good margin. It's gotten there because it's gone up so darn much. But why would I reduce my share count to punish a stock that's done great? I'm not going to do that. Robinhood's up 623% in my portfolio over 2 years. I haven't sold one share of Robinhood. I just don't want to get into a habit of the best performing stocks in my portfolio get punished. They get thrown out of my portfolio. No, thank you. So it's been great to have you in the community, Tomas, and talk about stocks like this. And it's also great to follow them along. Some stocks I don't get right, like Dow. It went down substantially yesterday or the day before on bad earnings. And man, that one was a pretty good downer. But some stocks I get right, especially the really important ones, because this one's the most valuable one in my portfolio. And I think this stock's heading toward $1,000. Can it get there in 2025? I think it could. I think it could get there in 2025, for sure in 2026, if they just keep doing what they're doing. This is a really, really good business. All right. So, Mike, you want Meta to go down? Yeah. That's why I don't want to sell it, is exactly Mike's sentiment. Is you get out of a stock, you believe in the company, you think they're going to do great. You may have a pullback, you may have a sell-off. It may kind of make you feel like, man, maybe I should have sold it when it was higher. So those things, I just don't want to regret on Meta. I think it's going higher. I think, in my opinion, Google's eventually going to be the most valuable company on the stock market. Might take a couple years to get there, but I think that's where they're headed. Meta's going to be near the top, and I think they have a great story. So comment on United Healthcare. United Healthcare is a buy, and it's just, I'm going to go ahead and talk about United Healthcare and healthcare stocks. I'm going to talk about those after I cover FinV and then quickly cover EVTL, because I think that's an important topic to take on. It could be a really good opportunity going forward, so I want to spend some time there. All right, let's talk about FinV, which is Finvolution. This is a company operated in China. They're doing well year to date, and for some reason, they've just been selling off pretty ferociously. Man, look at that sell-off. And I'm kind of scratching my head, because I'm going to tell you why I'm scratching my head in a little bit after I tell you about this company. Finvolution is an investment holding company, operates in the online consumer finance industry in the People's Republic of China, Indonesia, and internationally. It operates as an online consumer finance platform through its ppdai.com and ppdai mobile application. So these guys are operating, I think, a lot like, personal credit, like a SoFi like company. And I did really well with Futu, Futu, which is just doing phenomenal in China. And I thought this might be a good ad. I still think it may be a good ad, but it's just this new pullback is really confusing the heck out of me. It's like China's economy is doing better. I don't see a big problem there. The other stock, Futu, is flourishing, right? So we got Futu, which operates in that market. Now, Futu is a lot like Robinhood. They're a brokerage. They're not a personal finance app, but this sucker's up 105%. Beautiful. So how is this stock flourishing that way in China? And this stock is not. What is the pullback? There's something there I don't quite understand. So I've halted my buying of shares, and I want to see this earnings on August 19th before I really become more comfortable with the stock. I think certain things about them are terrific, like a super low PE, and the growth rate is not exceptional. It's just really low PE, and they're growing a little bit. Let's take a look at the quarterly. The quarterly is showing an acceleration of growth, which is good. Okay, that's good. I think it's discounted, nicely discounted, by the way, overall. But just the stock, the way it's trading is, making me concerned. I don't want to pour a ton of money into it and then be sitting on a big loser. It is oversold, 36.79. It's in oversold territory. So investors are just not liking, or not, they don't have an appetite for FinV right now. So maybe I got in a little early. I just need to slow down, because I do think that is a good business. And over in China, people are big savers and their economy is doing well, but they still have to maybe borrow a little money so that they could start a business, buy a car. Maybe a loved one is having a health problem. This one does have a nice discount overall. So I'm going to kind of slow down a little bit. I think stocks in general are expensive. It's not a good time to just kind of throw money around like, everything is going to go up. So this one here, I think, is discounted. I think it's interesting if they can continue to grow. Like if they come out with financials for their earnings where they show like 15% growth, I'm going to buy the stock. It's like, okay, these guys are growing faster now. They're a good sized business. They're discounted. Okay, I'm willing to buy, and I'm sure other investors would jump in with that type of fundamentals. So I'm going to slow things down. I still think it's a neat company. It's a small company, not very well known. It has a market cap of 2.2 billion. So it's a very small market cap in China, right? So it's not like I get to know them like I know Citigroup, which is here in the United States, or even SoFi. SoFi is here in the United States. We know who they are. We can really understand what they do. This one is a little different. It's way over in China. How do they use consumer finance? And is this brand really positive? I know SoFi is a positive brand, so those are the things that are going through my head. Right now, I'm at a pause with FinV. I'm not buying any more shares, but I think it's discounted. And today's action just again makes me pause. I'm like, down 5%. What the heck's going on? Meanwhile, Futu is down or up today. It was down today as well. So, okay, I understood. But this guy's just, I mean, Futu's kind of spoiled me, right? They've done so well. And this is out of China, this is the best performing stock. I own two stocks directly in China, Futu and Alibaba, and then I own an ETF. This guy's just been a really, really good one. So those are my comments on FinB, Mike. And I know over Discord, we've kind of communicated on FinB. I want to make sure you kind of got my point of view of what I'm doing with the stock because it's interesting. It may go places. It's just really confusing the heck out of me as it sells off. I'm like, why is it selling off? Maybe I got in a little early. Maybe I need to let it kind of settle down and then it'll start to rally. I'm going to be keeping an eye on it and most definitely reading their earnings when they come out. So that is FinV. Thanks for asking, Mike. EVTL, I'm curious. This one is going to be a little vertical aerospace, up 9%. Year to date, down 45%. 1 year down 28%. So what happened today? August 5th. Okay. So no news reported there, but let me see if I can get some news on Google Finance. EVTL. 2 hours ago. So analysts are talking about EVTL. Huh. So this thing's been selling off. Let's go study their business. All right, so Vertical Aerospace, an aerospace and technology company, engages in designing, manufacturing, selling zero operating emission electric vertical takeoff and landing aircraft for the use in advanced air mobility market in the United Kingdom. It involves in developing its flagship VX4 and eVTOL aircraft, vertical takeoff aircraft. It's founded in 2016, headquartered in Bristol, United Kingdom, 350 employees. Okay. So this is a space. So vertical takeoff meaning it could be like a helicopter. You can take off in a small spaces versus an aircraft needs an airport. And I think these are going to be used for transportation, especially in big cities where a person's going to get from one part of Los Angeles to another. This is what people would want. So the market cap 663 million, small cap. They're losing a lot of money. Okay. 4P is 2. Okay. Analysts think it's highly discounted. All right. So these two figures catch my attention. It's like forward PE is going to be 2. This one's going to be, they land a big contract, they're going to start selling on. So these guys are pre-revenue, if I'm reading the information correctly. They're just spending money. Got it. And obviously they're not going to have profit or cash flow. Take a look at the forecast. So we have 7 analysts covering this stock. And what are they saying is going to be their revenue in the future? So according to these guys, they're going to start selling their product in 2027 and 2028. And 46 billion. Right now we're back here. So we're a year and a half away from them beginning to sell their product. And they've been around since 2016. Boy, it's taken a while. It's taken a while to get this product to market. So 45, so I mean that would be 45 million in 2 years. You're paying like 13, 14 times revenue 2 years from now for the company. So that's really risky. This one's either going to be a big home run. I mean, it could be all kinds of things. They could come out, and I can't even study their their margins because they don't have any margins. Everything's just a loss right now. But I'm going to guesstimate that this is going to be a lower margin business, and those are not as lucrative and valuable as, let's say, a Meta that has 85% margins. So this one here is going to be a pass for me. I'm not in love with the industry. It's I can never like warm up to it a whole lot because they have low margins. And this is a market. I'm not a pilot. I'm just a consumer and I fly, but I don't like getting on. I've never been on a helicopter. I don't think I want to be on a lot of helicopters. Helicopters tend to be more dangerous than commercial flying. And vertical takeoff, I'm thinking, is that going to be a big thing? I'd rather take an Uber and stay on the ground. I would never take one of these, services. We just had a horrific accident in New York. A helicopter went down. This was like a month or two ago, and it had an executive from, I forgot the company, but that's an example. He was on that helicopter with his family. I think they were sightseeing, and that helicopter had some problem, and unfortunately, everybody perished. That's the kind of thing that goes on in my head. I'm like, well, once you get off the ground, it gets dangerous. And are these guys going to pull it off? I don't know. This would not be an investment for me. I'm sure if somebody had like the knowledge, like you're an aerospace engineer and you look at this and just making this up, but let's say an aerospace engineer / investor really believed in this space, really understood that these guys had advantages. That's an information advantage that investor would have. And I could totally understand that investor buying into this company, but not me. I'm not an aerospace engineer. And not the cup of tea for me. So thanks for asking. It's jumping up today, but it is a low price stock, $6.91. So it's easy for it to jump up like that. And there's a tiny cap. Just real quick, let's see if it's overbought. No, not really. 57. So it's moving up. It's being recognized. I'm sure that big bump in the stock today made it a little more recognizable. So thanks for asking, Mike. All right, so let's talk about United Healthcare. United Healthcare most definitely is discounted, and they're going to have a chance to tell the world what's going on the 29th of July, next week on Tuesday. And I'm really looking forward to that because I think that these guys have certainly been dealt bad break after bad break after bad break. And I think if they could start controlling the narrative of their company, things are going to get better. This is a terrific business historically. If you look at United Healthcare, they have a long, successful history. And this is what their stock has done. I owned United Healthcare for a long time. They made me a lot of money. Thank you very much. I sold them. I thought I'd switch from United Healthcare to Elevance. And Elevance hasn't been a total winner for me, but to see this stock jump, come down to $282 a share after this stock has been such a fantastic winner is really surprising. It's like, how does that happen? Well, it's just that, thing after thing just seems to be bad news for them. Meanwhile, the business just keeps growing. Grow. They're the biggest health insurance company in the United States. The brand is really well liked, respected in the business community. So those things really are still really good. If we can have a year of these guys just controlling their narrative through earnings calls and just getting everybody around their financials and show them this is a terrific business. Yes, there's stories out there like the latest is the Department of Justice is going to investigate their practices as they bill for Medicare. I'm sure they're going to come out fine. Maybe the Department of Justice finds a few things that they could say, well, they didn't dot their I here and they didn't cross their T. And some people may want to run with that, but overall, I'm running with their financials. And this business generates cash flow. It's always generated cash flow. Remember that thing those statements I was making early on this stream. The market will weigh cash flows, and over the long haul, reward companies that generate cash, put it on the balance sheet. It's certainly been the case for United Healthcare. The stock went from being a stock that was traded at $5, $6, $7 a share. And at their height, this was a $600 stock. Nicely done. And then they started, their CEO got murdered, assassinated, just a bunch of like bad stories around them. But this company, from this point when they were a $542 share per share price to where we are now, they're bigger, they generate more cash, they have great market share. All those things are still in place. So I am an owner of United Healthcare. I'm not buying shares until they announce, which is around the corner, Tuesday. Don't have to wait long. And are they going to announce before or after the market closes? I'm going to guess it's before. Let's take a peek at Tuesday. United Healthcare, they'll tell us one trading day. After today, we have to wait one trading day, and then United Healthcare is going to tell us this is what's going on. And I would be willing to expect that if they come out with a terrific earnings, we're going to see some fireworks. I hope that's the case. These guys could use one solid break, man. They've had so much bad luck. But all kidding aside, I think this is an obvious good opportunity, because when we weigh the value, all these terrific fundamentals, look at this growth rate. You don't grow a business that's $400 billion by 8% if you're a terrible run operation. You have to be good. At 8% growth on a $400 million number, that's $32 billion of revenue growth that you're adding into your enterprise. That's incredible. That is a sign of a great run business. That's what I'm gonna look at. If they can come in with like 10% growth on their earnings, look out. This stock's headed somewhere. And I've been buying at low prices, man. I'm just down a little bit on the stock, even after just some horrible news. Elevance had a bad earnings, and I didn't think it was that bad, but the market just destroyed them because their guidance was terrible. And then we had the story around Department of Justice and the Medicare billing practices and so forth. But when I look at United Healthcare, I think it is a discounted stock, because when I do a cash forecast for these guys and look at the cash that they're going to generate in the future, and I discount that cash to today's value, I find that the stock's discounted by 56%. Once we get all this bad news, they hire a permanent CEO, they get their business and their brand back on track, this stock's going to double. That's my expectation. Can it happen in 2025? Probably not. I'm probably going to have to wait till 2026, 2027. But this is one that I'm like, hey, I've made a lot of money on United Healthcare before. Glad to do it again. Let's go. And especially if they keep growing their business, it's just the stock's not going to stay down. So that's what's going on with United Healthcare. Thanks for asking, Tomas. Michael Anthony, good seeing you. I saw you on the stream with Trader Brad. Good to see you. Do you see CNC never made a loss, or did you see never made a loss? I don't understand that question. Can you rephrase that question, please? All right, Tomas, got you set up with United Healthcare. Talk to United Healthcare. And then let me kind of back up a little bit. So we talked about EBTL. All right, pre-revenue. Eduardo Elizondo de los Santos. What's my opinion on Dow? Just real quickly. Their earnings couldn't have been worse. It was the revenue's down, and it seems like they have no control of their markets. And I think the market really just disliked that. I disliked it as well. Other parts of material stocks are really working well. I thought Dow was going to catch some of that positivity. It didn't. So overall, I think Dow is in a really discounted negative place. Is it the right time for me to buy Dow? I don't know. I don't think so. I think I should wait, maybe an earnings or two. And when they get their business kind of solidified and growing, that might be the best point to start buying. All right, Mike, and I think you're referring to EVTL, and that's a good one to keep watching. And again, I'm going to keep repeating this. Sorry if it's annoying. We're in an expensive market. Expensive market means to me, slow down, slow down, slow down. If we were highly discounted, okay, speed up, speed up, speed up. But we're in an expensive market. So everything's going to be a little more expensive. And if you're going to take a high risk stock, I'd wait till we're nicely sold off. And maybe that stock is down 20, 30% for where it's trading today. And then you get in at a better price. But that's what I would do. And Tomas, yeah, their revenue's big, keeps getting bigger. All right, good. Okay, Centene is, okay, cool. And, I know that, Mike, you asked me about Centene. I think you asked me if my memory serves me right. This one went up 5.86, but I want to say that they had a bad day. Yeah, here it is. So they announced on July 25th, and that's when some things kind of fell apart for them. So they went from $29 a share down to 27. So they had a nice correction. They're down 2.83. So Centene operates as a healthcare enterprise that provides program services for underinsured and uninsured families. Okay. So these guys, along with Molina Health, do this. And when you look at the new big bill, it's taking dollars away from these types of programs. And I think that was part of the negativity around this stock. It's down big. Look at that. And this is when the big bill got passed, right? Boom, big bill gets passed. Hey, we're taking dollars away from this space, and this one's really sold off. This guy is in the same neighborhood as United Healthcare. And I don't know this company all that well. Right now in healthcare, you have terrific choices of discounted stocks. This would not be my first choice. I don't know this company. They're in a part of the market that for the next 3 years, they're not going to catch a lot of breaks because we have leadership in government right now that wants to get more efficient. And when it comes to healthcare, I admit there's probably some inefficiencies there that should be rooted out. And they're probably taking some dollars away just to make sure, hey, we're not wasting money. I'm all for that. And I think that once they take that medicine, I don't think they're going to get much money after that. The best run companies are probably going to thrive. Now, the reason I like United Healthcare a lot more is United Healthcare depends on corporate clients with well-paid people that have plenty of money to pay for their healthcare insurance. Whereas this one, we're depending on folks that are gonna struggle to pay for their insurance, and maybe these programs they were depending on are not going to be well funded. So that's not what I wouldn't want to be in this space. I'd rather be in the United Healthcare space. I haven't done a valuation on these guys, but let's take a look at their growth rates and so forth. So these guys, man, look at this PE, 7. Jeez. Analysts think it's discounted by 84%. Holy smokes. They're growing at 17%. They're a big, big revenue company, $169 billion of revenue. They have free cash flow of $1 billion. Now this one, let's take a look at the quarterly because they just announced, so the quarterly should be in here. Let me look. Man, look at that cash flow. $1.5 billion of cash, and they are a $14 billion market cap company, so they're cash flowing. At that rate, they would be cash flowing at like 48% per year, which is really, really high. All right, so plenty of cash flow. I could value this company, probably show you that they're discounted. It's normal for them not to be very profitable. That's health insurance companies. But this one it would not be my first choice. There's a lot of choices for healthcare payers. You got Elevance, United Healthcare. You got a long list of companies, and they all look discounted. So I would try to get to the one that you feel is going to be the best one for you. This one will be, if it works, it's probably going to double, triple, quadruple quickly because it's a small cap. United Healthcare, not so much because they're close to 300 billion. That thing doubles, it consumed $300 billion of capital. That's a lot harder than, hey, this thing moves to $100 billion in market cap. It took $85 billion of investing to make this stock go up 6x. That would be phenomenal, I'm sure, for investors. That's possible with a smaller cap, but it is a smaller name. It's higher risk. There's more unknowns. It is incredible how much the stock sold off, but it hasn't had a terrific 5-year either. What I was going to say was, see, here's a 5-year, right? From 2020 to, let's call it the end of 2024, the stock's down 8%. So it wasn't like it was an incredible success story and now it's discounted. I don't like that either. Now, when we deal with United Healthcare, it was going up, okay? It was going up. It doubled in value over 5 years. Mission accomplished. That's what a stock should do. And then it had all its problems and boom, it's down, okay? So this one is, okay, if they can get back on track and do this, the stock's going to double because they can get back to $600 a share very quickly once investors see that, hey, this is the United Healthcare that we gladly paid $600 per share back in 2024. So that's why I really like United Healthcare over Centene. I think Centene just, there's a lot of negatives there. I don't think I'd be the only investor that felt that way. All right, the market has closed. Let me take a break from specific stocks that we're looking at and see where the market closed. So we did grind higher. We're at an all-time high close with the S&P. Man, what an interesting year. We entered the year, we had a big run up at the end of the year. Stocks traded down when you had the whole tariff scare. The S&P down 19%. We took some really good medicine, really discounted stocks. Boy, this is when we're like just buying left and right and feeling like, if it goes even lower, I'll buy even more. But boy, am I glad I bought at that time. That is one where I don't have any regrets. Sometimes I feel like, man, I wish I would have bought more. Man, I wish I would have bought more. Not on that occasion. I executed what I wanted to do, and I'm glad I did it because now the market's up 28% from that point. Such an interesting year. We've had a full correction in the year, and we've had a rally back of 28%. Man, this is like a Marvel movie. The hero, everybody loves him. And then all of a sudden, the hero's journey, the hero struggles. The hero looks like he's going to be defeated. Oh, things are not looking good for the hero. And then Superman picks himself up and starts battling against the forces of evil and wins, gets the girl, kisses the baby, saves the world. That's the kind of market we've had. And we'll see if I have a feeling we're going to keep going up until we get some bad stories and then we correct again. But for now, we took our medicine earlier this year. We'll see if that's going to be the case. The NASDAQ's doing well. Russell looks like the small caps did okay today, and then the Dow did okay today. That is terrific. Nicely done, stock market. Keep moving higher. Now that we've closed, let's take a look at the heat map and see where stocks landed. Looks like NVIDIA gave up a little bit. Microsoft gained a little bit. Palantir, look at that. Nothing's holding Palantir back. Tesla is trying to recover some of its losses. Amazon gave up a little bit. Google advanced a little bit. Meta gave up a little bit. What gave up a lot of? Looks like Comcast had a bad day and some others. Intel had a bad day. ServiceNow had a bad day, and they had a very nice day a day or two ago. Their earnings were pretty good. I thought their revenue growth was pretty darn good. So I'm not sure why they're trading down. But you can see a lot of green on the screen, and man, this market, it is so fun to be a stock investor. But you're just constantly, what's fun about being an investor is the situation constantly kind of evolves in front of your eyes. Like, okay, what's this market going to do now, right? And you're trying to figure it out, which is fascinating. I could do this for another 100 years. I'm not going to live that long, but I could do it. All right. So 1 week, Google, Amazon, Palantir, Lilly. Good to see some healthcare stocks showing up. J&J had a really nice earnings. Nicely done, J&J. And they announced a week ago, like a week and a couple of days ago. All right, so that's where we're at there. Let's get back to, let me show you the super investor list real quick. Tom Lee still on top. Robert Vinall, 21%. Nicely done, sir. David Tepper, Kathy Wood. Everybody makes fun of her, but she's making fun of them right now. Michael Burry. The Corporate Raider, Carl Icahn, 13%. Guy Spire, up 8.95. Looks like I have to work on the sort because Howard Marks, his portfolio did advance a little bit. So that's what super investors are doing. All right. So let me get back to the comments in the chat. Now, just a reminder, you're a member, give me a ticker. We'll go deep on it. You're not a member, $5 super chat or become a member. Very easy to do. Just go to my home screen. Go to the YouTube home screen for my channel. You go to this button down here. It says join. Click that button, and you get the 3 different options that you can become a member on. And each option, any of the options you pick, enable you to put up tickers of stocks that I can analyze on live streams. You can also attend investor calls. You get access to my research. You get invited to the Discord. A lot of good perks. So take a look at it. It'd be great to have you as a member, and please consider it. All right, so that's that there. Neil, good to see you. Let's see here. $150 politician, or I'm not following that one. Good to see you, Neil. So, PayPal, let's take a look at PayPal. Because I agree with you, the market is not in love with PayPal, but I'm going to show you something I hope you find interesting. So let me park that. Next one we're going to cover is PayPal. Mike, I have UNH, ELV, CNC, Oscar, and others. Ha, man, we could really use a rally in healthcare. Such a beat up space. If UNH gets to 500, you're out. Good plan. Good plan. I'm going to keep, we got earnings on Tuesday. Let's see what happens Tuesday. Shadow Guy, Montana Aerospace. Geez, Montana Aerospace has doubled. Nicely done, sir. Nicely done. Aerospace has just gotten so much investment. There's reasons for it, right? Countries are having to spend more on their defense. Very nicely done. All right. Great, great. Good stuff. So let's talk. I wanted to talk about PayPal. So here's what's interesting about PayPal is, they most certainly have not been an investor favorite. Year to date, the stock is down. And for the 1 month, the stock is up. So it's up 6%. It's kind of been flying under the radar, but I did notice this on because I own PayPal. I like to look at the 1 day change, the 30-day change, the year-to-date change. And I noticed that it was showing up on the 30-day net change. This is a discounted stock because it's got a $75 billion market cap. You're paying a little over 2 times sales for the company. Not very expensive. PE 17, not very expensive. Considering that they're growing. They're not setting any records on growth, but they keep growing. And that growth to me means they keep expanding, getting more customers. They're going to start monetizing Venmo better, which is a good idea. Venmo is super popular, and they're going to start monetizing that. Free cash flow is superb. Okay? That's one of the good things about PayPal. So A, it's been working for 30 days. If it could keep working, this one's going to be solid. They announced on Tuesday. So keep your eyes on PayPal. Similar to Google, you know, investors started buying into Google as we approached their earnings, and it seemed like investors kind of smelled something positive was coming. I'm seeing investors buy into PayPal. So maybe that's also the case. The RSI is at 65, showing that this stock is approaching the overbought territory of above 70. So it's a lot better than seeing like a 35, which is a stock we saw earlier, I think a healthcare stock. So PayPal is kind of going stealth right now. It's under the radar. It's not being noticed by many, but this stock can really work if investors fall in love with it again. Now, one thing they did a couple years ago is they established a stable coin. Now, if they can go big on stablecoins seem to have really caught the investors' attention and imagination. And I think they could really go big there because they're a payment company and they're like a new generation payment company. And they could start really making that a lucrative part of their business. So for sure. So they're growing their business. They have a lot of accounts. They can introduce their stablecoin quite well, keep producing that free cash flow, and we'll be in good shape. PayPal is discounted, but what we have not had is just an appetite from the investing community to buy PayPal. Well, they've had a good 30 days. Okay. Don't want to make too much out of that, but they can have a really good earnings. Maybe that 30 days turns into they'll have a really nice 90 days, maybe 6 months, and they can really start moving up higher. I think PayPal is a terrific business, but right now I've been in the minority for maybe a couple of years. Maybe it starts working again. This stock was really worth a lot during COVID. During COVID, this thing was worth like 4 times its current valuation. It was way up here at $300 a share, and we're trading down at $78 a share. Holy smokes! What a correction! This thing corrected like a lot of stocks and just never made it back. Over the past year, it is doing quite well because it was so oversold. It was tracking quite nicely for maybe about 5 months, and then it sold off again. And ever since, looks like April, along with a lot of other stocks, this stock has been moving up 35%. And as mentioned, over the last 6 months, not setting any records, but it is showing a positive trend up. So we'll see where PayPal goes. I think if they have a good earnings, this is a stock you don't have to be in early. You can be in late. You can wait, let it rally for a month and then jump in because it has a long ways to go. It has very good fundamentals. If the market just likes it again, this stock can really, really go up a lot. So that's PayPal. I thought it was interesting to show that because it's really moving. So Shadow Guy, Cadence. So CDNS. So let me get refamiliar. I've heard of this company. Cadence Design System provides software, hardware, and other services. Yeah, so they use software, and when chip makers want to test their chips, they do it on Cadence. There's like 3 companies that do this. So they are in the semiconductor ecosystem. They're not producing semiconductors. They're selling to the companies that do produce or design semiconductors so that they can test the true performance of their semiconductors, and that's where they sell. It'd be interesting to see if they're growing. Wow, they're growing nicely. Okay, 1 year up 25%, 5 year, man, good stock, good looking stock. Okay, $90 billion. Investors are paying about 20 times revenue for the company. High PE, fairly priced according to analysts. And that is good growth, but it's not incredible growth. Their growth has accelerated in Q4, Q1. That looks good. 20% growth. Okay. Let's look at the margins. So gross margin, wow. That's why I like software companies. 85% margin. And they have free cash flow. Just I can't get to that valuation, nowhere near it. I can get to maybe 40 billion, but I can't get to 90. Maybe I can get to 50 billion, but no way can I get to 90. And this is a cyclical space. You're going to see them do well, and then things are going to be go down, because once you build all the semiconductors that the data centers need, and there'll be kind of a letdown, revenues will go down. That's what tends to happen. These guys are on the smaller side, about 5 billion in revenue. So this is looking good. It's doing well. It's not like screaming up in value. They are announcing on Monday, so it'll be interesting to see what they announce. Cadence Design. Good seeing you, Mike. Have a terrific weekend. All right, guys. So we are up to date on the chat. Looks good. Let me see if I've got a couple more stocks that I want to look at. If you guys want to look at a ticker, let me know. If you're not a member, $5 super chat, or if you're a member, just put the ticker in the chat, and I'll be checking the chat as we go through this. All right, so let's take a look at Docusign, or actually, no, I'm sorry, NVO. So NVO is a big pharma company, and these guys, along with some others, I've noticed it's had a nice little rise over the last couple of days, up 10%, Novo Nordisk. It announces on August 6th, so we're about 2 weeks away from these guys announcing. And they are big cap, 315, big revenue, and they have good growth. So these guys are a nice value stock for those types of investors that pay. This stock pays a dividend, so it looks good. It's discounted according to analysts. I also agree it's discounted, not by that much. I think it's discounted by more like 25%. And it's been showing some positive signs lately. So the 5-day up 10%. And I really like the growth rate on a big business like this. The cash flows look good. Free cash flow really high. And this is in the Danish, I think it's the Danish currency. Yeah, the Danish, I think, I forgot what they call it. So this is, I'm just going to show growth rates. And the free cash flow is really good in proportion to their revenue, and it is growing really nice. Gross margins of 84%. Pharmaceutical. This is why it's really desirable. So this stock here, I think I'm a buyer, and I've been buying into this stock, and I'm glad I've got a position in them. Right now, I'm either even or up a little bit, and looking forward to their earnings in a couple weeks. I think if they continue to announce positive earnings, this one can really work. This is a little bit of a lower risk, more of a value stock that I really like. When we look at Novo Nordisk, I think it's 23% discount. And I know that you may be thinking, well, it's not a big discount, but it is a very well-known name. It's in a space that I think is going to keep working well and pays a dividend. So it's a good value stock. I hope it keeps getting better. And these valuations can get better if they announce and really bring up their fundamentals and show that their fundamentals are a little low and can really be raised. That would be a positive for Novo Nordisk. So that's Novo Nordisk, a nice value stock. But that's not fun and exciting. Let's talk about a fun and exciting stock, which is Alab. Astera Labs just been going berserk. It's up 40% in a month. And these guys are a $20 billion market cap company. They're $490 million in revenue. So, geez, investors are having to pay like 45 times sales. Is it worth it? Well, when you see that the stock is, or I should say the company's growing by 200%, you can't find 200% growth very easily. You can only find it with a couple companies. And you find it with a stock that is producing free cash flow and highly profitable. What's there not to like? So this is a really interesting stock. It goes up with NVIDIA in greater proportion. And I think it has a very good valuation. I started buying into this thing when it was much lower in price because I did see a really strong pullback. Say to buy around here. I'm up nicely on this stock and just think this stock is going to be a rocket ship. It already is taking off nicely, but they're going to announce on August 5th in about a week and a half. And man, if they announce another 200% growth or even better, look out. This thing's going to keep flying up. So this one's fun. This one's a lot of fun to watch. It has crazy volatility. Some days it goes up 20%, and some days it drops 15%. So you don't need to go to exciting movies. You become an Alab stockholder and you see it jump up like 27%. And then on the downside, you could see it, collapse 32% on one day. Holy smokes. That's got to take some internal fortitude. But it's not about, buying stocks at a discount is really important. That way you buy them like this stock here. I started buying when it was really nicely discounted, and the stock is up in very, quick order. It's more than doubled in value in over the course of less than 5 months, because this thing is really fundamentally exciting. 200% growth rate on revenue, 75% gross margins. As they get bigger, those gross margins are going to get bigger because they don't have to expand their engineering department a whole lot because they already have the engineers that are brilliant and can create the new designs for the chips that they produce. So I think that the gross margin is going to expand and the profits are going to expand and the free cash flow is going to expand. They have a terrific balance sheet with more cash than debt. Let's take a look at the RSI. RSI is at 70. Perfect. Just wouldn't want to see it higher. That means that, hey, stock market's paid attention. This thing pulls back, there's going to be buyers. Boom. And we're going to leading up to their earnings. I am looking forward. I'm going to get the popcorn ready and watch the show that comes out on August 5th. That's going to be a fun one. So that's Astera Labs. Really exciting stock. Love watching it. And that's Shadow Guy. 45 times sales. As a Palantir investor, that's cheap. You make a good point, sir, but your Palantir stock's been killing it. Absolutely telling the market to get out of its way. It is going up. I don't care what anybody says. It is going up. 1 year return, 497%. Look at this graph too. Isn't that a beautiful chart? This is like if Van Gogh was creating charts, he'd probably create one like this. He would call it like, instead of Starry Night, he'd be like A Star is Born in Palantir. And this thing is just such an incredible stock. Look at that return, 2,000%. And yeah, this is a little expensive. $3 billion revenue company. It's $374 billion in market cap. Wow. So what is that? About 120 times sales. Oh, incredible. PE is only 688. Just saying. And then 33.45% growth rate looks good. I think the quarterly looks terrific. 39% looks good. When is Palantir going to announce? Come on. Stock analysis needs to put a couple more NVIDIA GPUs in their tech stack. They're going to announce on August 4th. And I think August 4th, is that a Tuesday or a Monday? think it's a Monday. So they're going to come out. We'll see what their earnings have to say. Incredible. Incredible. Palantir. All right, so we went over Alab. Let's go over Docusign. Docusign is another stock like PayPal. It's just been doing its thing, not catching much attention, but it's up. You know, it's just been climbing up, and this has been a good stock for my portfolio. It's just quietly done really well. Now, it hasn't done great since December, but year to date, it's 11%. For the 1 month, it's up 5.59. It's going to announce September 4th, so we're way away from earnings. This is just a fundamentally sound company, growing at almost 8% revenue, $3 billion in overall revenue, and they're growing at 8%. They do have terrific margins in cash flow. Their margins are 79%, and they have very good cash flow. So this thing prices out for me, and I still think it's discounted. I've made good money on it, and I'd love to see this thing be acquired. Love for some other big company to say, hey, we want this digital signature capture company, swallow it up, pay investors a nice 50% premium on the current stock, and I ride off into the sunset. I'd love for that to happen. Or these guys just keep getting bigger and bigger and more valuable. I think either option is going to make this a very good investment. So far, so good. I've done well with Docusign. So this one is quietly avoiding radar and going up. We'll see how it does as we see earnings announced all over the place. All right, so that is Docusign. And those are the stocks that I had listed. Looks like I'm caught up. Was able to get through the entire list. Looks like Michael Anthony, Palantir only made 0.13 last earning. Look at gap earnings last year. Okay, yeah. You know, Palantir, I made the mistake of looking at fundamentals. Palantir is a different animal. Investors love the stock, and they'll continue to buy it. And Palantir, I don't think has many super investors other than Kathy Wood and Tom Lee. So those two investors, I think, are in Palantir. But when you look at more of the traditional names of super investors, we have one investor in the stock, David Katz, and not a lot of investors. And this is a big cap, right? It's like, geez, why aren't the investors bought into it? And I think it's because Palantir has been a retail-oriented stock. A lot of retail investors buy it, and it's just really gone up. So it kind of has taken its own journey. And we'll see where it goes. It's just been a rocket ship ride for investors. Congratulations to all those that are in Palantir. So good stuff. So that is Palantir. All right. So market is closed. There is a little topic that I wanted to bring up, and that's the meme stocks. Another sign that the stock market is really expensive is when you have these meme stocks. You have stocks like Open for Open Door doing some crazy things, right? Like, look at this. Stock was at 56 cents and it just shot up. And I think the story behind this one was this investor that did pick Carvana and he nailed it, made a lot of money. Anybody who followed that tip made a lot of money on Carvana. Well, that guy said similar things about Open Door and said, hey, Open Door can really be a 100 bagger was his term. Wow, that's saying something. But the fundamentals are not exciting, right? You have a stock that or revenue that's gone up and then come down. What does Open Door do? Okay, Open Door operates digital platform for residential real estate transactions in the United States. It buys, sells homes. Company offers sell to Open Door product, which enables homeowners to sell their home directly to it and resell home to a buyer. Okay, so you get a cash offer, which, you know, is a homeowner getting the best price? Maybe. Looks like It worked for a while. During the COVID times, people didn't want a bunch of people walking through the house and getting them sick. So I'm sure that was part of their growth. But since then, they've had a pretty hard 2023, a hard 2024. They've been stabilizing and beginning to grow a little bit. Now, when we look at the rest of their financials, they're losing money. Okay. Are they cash positive? They are burning cash. Last year and a quarter, they burned cash. They were producing free cash flow in 23 and 22, but that's cash burn there. Gross margins are really low because it's real estate. We saw a pharmaceutical company earlier in the stream do 85% gross margins. We saw Alab do 74% margins. Those are really desirable businesses. 8% gross margins, not desirable. You got to sell a lot of revenue to make money. And in this case here, they're losing money. Okay. They're burning cash. So that's not good. Let's look at their balance sheet. So their balance sheet is, they've got about $2 billion of debt. And they're not making money. So they got debt. They're burning cash. RSI is at 69.86. Yeah. So they've been selling off a bit. Looks like they peaked out after that comment. And I think the comment came in, it really shot up. It settled back down. I don't know if it's going to do anything, but the thing I'll point out is we're in an expensive market, and having meme stocks is just one more condition that tells me we're in an expensive market. We're now dealing with meme stocks like Open Door and then Krispy Kremes. Like, what are we doing here? What are we doing? Donut shop? Seriously? So Krispy Kremes has gone up 70%. This is a market cap of 754. These are small caps, so they move a lot. Revenue is 1.6. They're not making any money. And analysts do say it's a buy. This is a restaurant. They make donuts, they sell coffee. They've been coming down in sales. Ben Affleck is one of their spokesmen. I think he's their spokesman because he's from Boston, and I think this company's headquartered in Boston. They were growing nicely, but this is a low margin business. I don't like restaurants. Too many problems, not enough profit. Gross margin is 25%. No, thank you. I want higher gross margins. And they're not making any cash flow. So that's a problem. So this one here is a meme stock. Fundamentals don't look good. And I couldn't give you a valuation because they're burning cash. Their RSI is at 76.89, so it is overbought. And they have more debt than they do cash, about $1.44 billion of debt. That could end up being a big problem that drives them into bankruptcy. So this one here is somebody else's investment, not mine. The meme stocks are showing up. Just, again, it's a condition that shows that we are in an oversold, overbought market, I should say, not oversold. Now, the last one I'll show is Kohl's. I do not like retail, but Kohl's caught a rally. Small cap, revenue. They do have profit, okay? These guys are a little different, but you see their fundamentals. They're just losing revenue. They're losing market share. No doubt that Amazon is part of the problem, that they have to compete against online. They do produce some cash, but where's this business headed? Is it going to get easier to sell retail? No, it's just going to keep getting harder. This is kind of no man's land kind of business. And this is kind of bottom feeding. You can buy this stock. Hopefully it doubles in value and get out. But you're not buying on the expectation that Kohl's is just going to be one of the big businesses of the world, like a Walmart or something like that. No, these guys are going to try to survive until they get put out of business by online or the latest and greatest new retailer that does it better, or the discount retailers. Like the discount retailers tend to be pretty darn popular. They get a hold of really low cost merchandise, maybe was overproduced, and they get that, and they offer a really good price to their customers. So I'm talking about, the discount retailers, and their names escape me for the minute, but this is just not. This isn't. This isn't where I want to play. I want to find stocks like, Alab, that have this super neat semiconductor, or Meta. They control their destiny. They have such a bright future. I want to be in that stock. I don't want to be in a retailer that's just trying to survive. And they caught a rally, and they caught, the meme action. This thing here is it. Its relative strength is 64.57, so it's not really terribly overbought. It's probably kind of digesting this big move and now beginning to go down. I wouldn't be surprised if this thing goes down to $9 a share in short order, and then anybody who gets in at this point is just going to be on the pain of misery. So the meme stocks are here, and it gets a little wild. But if you recall, in 2021, we had a bunch of meme stocks, and 2021 preceded the big correction of 2022. So it's a little bit of, hey, that's one more symptom. We have an expensive market. This type of action you only see in an expensive market, because there's not a lot of places to find value. There's not a lot of places to catch a nice rally. Everything's rallied up. So that's another symptom there. All right, we talked about super investors and when they lie, where they lie. Tom Lee's getting it done. Getting it done. Nicely done, Tom Lee. We went over Google. We haven't gone over Tesla. Now, Tesla, I'm not a Tesla investor, and I don't try to make sense of Tesla. I stopped doing that a while ago. They're not doing so hot if you look at the fundamentals. Their revenue is contracting. That's a very bad sign. They're selling fewer cars, and Elon Musk guided that the next couple of quarters are going to be bad. Having said that, their revenue is contracting. Their margins are margins of a car company. Gross margin is 17%. Let me show you a technology business. Technology-oriented business would be NVIDIA. And when we look at their gross margins, you're going to see what a technology company does, 70%. And it'd be even better with Meta. Let me go to Meta. I think Meta is going to give us even better margins. And the point that I'm trying to address is, I get why investors would be, really in love with Meta. They earn almost 82% gross margins. Their profit margin is 39%. Free cash flow margin, 30%. Now let's go to Tesla. A lot of people say, oh, that's a technology company. Okay. Where are my technology fundamentals? Where's my 80% gross margin? No, 17. That's a car company gross margin. Where's my technology profit margins of 30 to 40%? No, 5%. That's a car company. Free cash flow margin, less than 1%. Okay, well, this looks like a car company. It smells like a car company. It must be a car company. And we'll see if they pull off the robo-taxi business. That would be a win. But our friends over at Google Alphabet have a pretty good lead in Waymo. Now, Elon Musk is going to spin his stories, and you know what? Investors will probably buy it, and the stock may rally. We'll see. Year to date, this one's down 21.74, and it's not really showing that it's going upwards and onward. Over the 1 month, it's down 7%. Over the 5-day, down 4%. It really gapped down when they announced earnings. And I think people did have a moment of reality, like, whoa, this is bad. And the guidance was bad. The best that investors could hope is these guys are going to have such great technology in the future that's going to make their robo-taxi service go number one, but they're not number one right now. They're behind Waymo, and Uber's come out with a new competitor, which is going to be a combination of Uber with Neuro, which is a technology platform, and the cars are going to come from Lucid. 20,000 vehicles are going to be deployed in the US. So the competition is going to heat up on robotaxi. It's not going to be an easy market to dominate. There's plenty of competition. So Tesla, we'll see where it goes. But I'm not going to be a Tesla interpreter. I think the stock will do what it does. Investors fall in love with it. It rallies up. It comes back down. I mean, look at these. This volatility just up and down. And if you look at where the stock has gone, it really did become an incredible stock when it went up. But since then, it's kind of gone sideways from a high level. And once you get these compares on the books of 2021, it's going to show that investors over the last 4 years, this hasn't been a great stock, but we'll see. So Tesla is not headed in the right direction in my position. So we'll see. All right, so that is Tesla. I'm going to take a peek at Microsoft, Amazon, Meta, Apple, since they're announcing next week. Let me check on the chat. Gentleman X. In this market, when do you decide to exit stock Futu? Yeah, I'm not selling Futu. I think it can go higher. Where am I at with the valuation on Futu? I still see Futu being discounted by 20%. And that's with the fundamentals they put on the books. And each earnings, the company can get more valuable. We're in a very bullish market. I'm sure investors in China and Asia are transacting on the Futu platforms that much more, like they are on Robinhood and Charles Schwab and all the other companies that have been flourishing like Interactive Brokers. So I'm expecting great earnings from Futu, and the stock's going to keep going up. So I'm not selling Futu. I probably wouldn't sell unless it went from $163 a share to like $250 a share. Maybe I'd sell there. I'm doing great with the stock, and it's going to stay in my portfolio. These are really hard to find. These stocks that are growing nicely, really profitable. They have an advantage in their markets. They have a really great future. These guys are going to keep getting bigger and bigger. And I want to be a part of it. They're only a $22.78 billion market cap. Robinhood's already $100 billion in market cap. These guys are in China. The addressable market there is huge. Robinhood has a lot of competition here. Futu doesn't have a lot of competition in Asia. So I'm staying put. I'm staying put on Futu. I want to wake up with a 10 bagger on my portfolio someday. All right, so Arista Networks, I did a video on it. Check my channel. I thought they were overpriced, and they're still overpriced. Why move in SMX? I don't know what that comment means, Michael Anthony. Gentleman X, thank you, sir. Thanks for joining. Bloomberg report that growth is long down, that people will not buy. Bloomberg report that growth is a long down. China has real problems. That's a big statement. The US has big problems. Germany has big problems. China has big problems. I agree. All the people that believe the opportunity is big in the United States and all the people that believe the opportunity is limited in the United States are correct. It's you pick the side based on your research and observation. In my opinion, the opportunity in China is huge, huge population, advantages in manufacturing. They're growing their GDP faster than the US by like 2 times the rate. There's a lot of things to like about the Chinese economy. I don't like their government type, but that's the government they have. Here we have democracy in the United States. I like that a lot more. Now, do they have problems? Absolutely. But is the opportunity massive? Humongous. I think the 2 biggest markets to invest in, United States and China. And that's easy to determine. Nobody's going to argue that. China is the second biggest economy. At some point, it will be the largest economy on earth. It's growing twice as fast as the US. At some point, it will pass us up. So I'm not jumping into Chinese stocks head first, being careful, but I recognize huge value, huge value. The organic growth you can have in China, we don't have that here in the United States. Like for Futu, there's a lot of net new investors that are buying stocks for the first time. In the US, I think everybody who wants to buy stocks already has a brokerage account. The new investors are young people. They turned 18, 21, 25. They start investing in stocks. That's an organic new investor. Where Futu is dealing with 50-year-olds that have never invested and are opening an account for the first time. That's organic growth. There's a lot of that in China. And I can go on to other markets like cars. There's some families that never owned a car before. Well, they're buying a car from BYD, organic growth. Here in the United States, geez, I've owned 25, 35 cars in my lifetime. My family, collectively, we've owned 40, 50 cars. It's a different growth opportunity, US and Canada, China. So keep that in perspective. And I respect that, some people don't like investing in China. Totally respect it. I understand their points. Me, I'm a capitalist and I want to make money. And if I can make it in China, I'll make it in China. Most of my money's made here in the United States. So looks like Braden Anders, good to see you. What do you advise to prepare for the correction? What I would say, it's a very good question. And I'm going to tell you how I look at it. And then you interpret whatever you'd like out of it. So seasonally, we typically have sell-offs in September and October, and it's almost like setting up for that to happen. At this point, it looks like the month of July is heading to be a positive month, and the month of July tends to be green most of the time. If you look at the last 10 years, it's been green almost every single year. If you look at September, it's like half the time it's red, half the time it's green. And we're setting up for a correction to happen. Maybe as early as August, but maybe the party continues. And then we have a pretty good correction in September. Now, the first and foremost is I don't believe in I'm going to sell half my position and then buy very quickly again. I'm just not put together that way. I want to find great businesses and I want to hold on to them. Okay. That's my mentality. That's my philosophy. And a good correction would enable me to deploy capital. So one thing I am doing to address your question directly, I have a fair amount of capital that's in cash, and cash being short-term treasuries earning, 3, 4, 5%. I'm not buying a lot of stocks right now. I'm not buying any stocks until the month of August, period. Just pausing. I'm like, okay, market's expensive. And if all my dividend money that's coming out of my portfolio, I have some bonds that are going to redeem. All that cash is going to stay ready. So when we have the correction, I buy into it. I'm a dollar cost average buyer. And that's how I'm going to take advantage of an eventual correction, is I have cash capital to buy stocks. So if you offer me a nice discount on Uber, let's say Uber sold off by 20%, I'll snatch it up. Google, snatch it up. Alab, snatch it up. Just fill in the box. If the market has a strong correction and you start discounting these stocks, I'm ready to go. So that's how I'm addressing it. And I don't know if it's going to happen in August, September, October. If and when it happens, I've got cash. That's how I'm going to deal with it. Okay. Take advantage of it. That's how I take advantage of this correction. I had cash. Now, if you follow my channel, I was, saying on these live streams and on investor calls, guys, I'm getting nervous. I'm getting nervous. Why? Because things are too good. When everything's perfect, it's like, okay, I'm nervous, nervous, nervous. So I started to sell some things, getting out of some stocks that I just thought those companies were okay, but not great. Created some capital, created some excess capital in cash, and then I was ready for this guy. Well, I'm in a similar boat now. So I've created capital, I've created cash. I did it in a way where I'd never touched, some of these companies that I want to hold for a long time, and I'm ready to go. So I would encourage you to think about how are you going to have capital to put to work when this happens again? That's the homework for you. That's how I'm doing it, and I'm kind of already ready. I'm already ready there. My cash position is going to keep growing by the dividends I earn, interest I earn on my bonds as well as my cash balance. So that'll just keep getting bigger. Q Tong Nguyen, can you say anything about GA? What about Grab Holdings? Grab Holdings is interesting, but I'd rather own Uber. And Uber does own 20% of Grab, by the way. So when you own Uber, you own 20% of Grab. Grab isn't growing all that great. Their profit margins are not great, and they're in another country. I'm in the United States. So I'd rather own Uber, and I own a lot of Uber. So that's my response on Grab. All right, so let's hit Microsoft. And let's hit Amazon after that. So Microsoft is a very valuable business, deserved high market cap of 3.8 trillion, $270 billion of revenue. So you're buying the company 15 times revenue or so. They are very profitable, and dividend, small dividend. PE is a little high at 39.7. Analysts think it's a little discounted. This stock has worked year to date. It's done okay for the 1 year. And this one was kind of setting itself up. I bought into the stock and I decided to sell it. That was a mistake. I should have hung on to it. Didn't have a big position, but it was still a mistake. I should have held on to it. So stock's doing well. Company's doing well, growing at 14%. That's a huge number, $270 billion. So 14% on that number, you're looking at like $40 billion of additional revenue that they have in a year. Impressive. Their gross margins, 69%, very high gross margins. Operating margins, 45. So the margins look terrific. Free cash flow margin looks awesome. These guys are priced in my book at a premium. Analysts will just look at earnings per share, and they believe the stock is discounted by 8%. The RSI, 71. That's about right. People have been buying into Microsoft, Amazon, Google. So this one here announces on the 30th, which is Wednesday. Is that Tuesday or Wednesday? No, it's Wednesday. And I'm expecting they're going to announce good earnings. They're going to be probably in the same kind of level of positivity as Google. So I think the stock's going to keep working. I think this is a good stock and setting up nicely for their earnings. Microsoft looks good. Amazon is an incredible company, 2.46 trillion. Year to date, it hasn't been doing as well as Microsoft or Nvidia. It's up 5.5%. Humongous revenue, 650. Microsoft was 270, if you recall. So these guys are twice as big as Microsoft. Whew. PE 37. Strong buy, 10% discount. I have Amazon is fairly priced, and I'm still buying shares on big pullbacks. 10% growth on a massive number. They're growing their revenue by $65 billion at this rate. They don't have the high margins because they have an e-commerce business, but their margins are at 49. Jeez, that's huge. on such a big business. They're profitable. Free cash flow is a little low because of two things. One, they're such a big business, and two, they're putting a lot of money into their data center for AI and to grow their capacity to offer more cloud services. And they're building other businesses. Like, they quietly have a huge robotics business. Of course, Tesla would like to tell you stories about how big their robotics business is going to be, and robots this, robots that. Amazon has over 1 million robots installed and operating today in their warehouses. 1 million. So imagine them taking that know-how technology and selling it to their customers that also run warehouses. That's another business. Boom. And they're doing great in their e-commerce business, their cloud business, their streaming business. These guys are loaded. So it's one of the stocks that I want to own. And they're going to announce on Thursday after the market closes. And I expect they're going to do well. I expect they're going to announce, especially around their cloud business. I think their cloud business is really going to expand because you're seeing so much investment in AI. So these guys are going to be a big winner. And I'm glad I own the stock. I'm going to buy on pullbacks, but right now it's fairly priced. Meta is going to announce next week. I covered Meta at length at the beginning of the stream, so I don't think I need to cover that. Doing well year to date, doing exceptional for the 1 year. And they have a reasonably lower PE compared to Amazon and compared to Amazon and Microsoft. The PE looks really good, 27.85, and they have a tremendous future announcing on the 30th. So looking forward to this one. I think this stock's going to move to $1,000. Braden wants to look at VRT. Let's take a look at it. All right, so I've looked at VRT in the past. And let me get re-familiar with it just to make sure. It's Vertiv, okay. So Vertiv Holdings, together with its subs, designs, manufactures, and services critical digital infrastructure technologies and life cycle services for data centers, communication networks, and commercial and industrial environments in the Americas, the Asia Pacific, Europe, Middle East. It offers AC, DC power management products, switchgear, bus bar products, thermal management products, integrated rack systems. Okay. So data centers are really growing, and they definitely need the gear from VRT. These guys have been around a while. I think if I look at their profile, so where's the year when they were founded? They usually have that here, but it looks like I'm not going to get it on this company. So let's take a look at their website just to get acquainted with their products, because it's important to know you're in the data center. That's great. But I'll use the analogy real quick. Football season is going to start in a month. And on a football team, you have probably the highest paid person in the organization is the quarterback. Makes $50 million a year. On the same organization, you have an equipment manager. They're both part of, let's say, the Philadelphia Eagles. They're the Super Bowl champs. You got a quarterback, equipment manager. And they're both very proud of their positions. They both put a full effort into their jobs. They both are valued by the organization. But the quarterback gets paid a lot more. I'd rather be the quarterback versus the equipment manager, which is probably making a decent living, but probably more like the average salary of a U.S. Worker. So we'll determine where Vertiv lands. Obviously, NVIDIA is the quarterback in the semiconductor data center business. They are the quarterback. They're paid $50 million a year, a season. Where's Vertiv? Are they equipment manager, or maybe a couple rungs higher? Maybe they're a linebacker, a special teams player. We'll see. So these guys do their products. They do UPSs. Okay, that's all kind of hardware based. Switches, switchboards, hardware based. Liquid cooling. This is like plumbing, very high end plumbing to run water typically and enable the cooling of all these GPUs and servers because they really run hot. They're putting a lot of power through these things and they create a lot of heat. They have racks, which are cabinets made out of steel, and they're painted black typically, and these are racks put into data centers. So all this is hardware, okay? This is all hardware. Now, hardware, I've been in the software industry for a long time. There's a reason why I went software versus hardware. The margins are a lot better in software. Hardware margins are low. All right, so now that we got familiar with what kind of products they have, let's take a look at this company. This is a $52 billion market cap company. Revenue is $8.4 billion, so you're paying 6 times revenue. Okay, net income is good. PE is a little high at 76. Strong buy, fairly priced. Year to date, it's up 21%. Over the 1 year, it's up 75%. When we look at their growth rate, very good growth rate, 20%, because we have the data center build out. Very good. That's very good growth. Okay. And when we look at their margins, 36%. So NVIDIA's at like 80 some percent, 36%. So these guys are not huge margin business. Their net profit margin, 8%. They do have good free cash flow at 15.69. If I look at their cash flow number and I value this company, I'd probably get to 40 to $50 billion of value. I may have a valuation on VRT. If not, we're going to go ahead and create one. Oh. Yeah, there we go. Okay, so here's Vertev. And let's look at the fundamentals, and then we'll come back here and go over how I value this. So here's Vertev. They're lower margins. Let me open up NVIDIA. So NVIDIA, see how dynamically their business has grown. At the same time, Vertev's grown 20%. These guys grew 86% because they get to increase their price because their GPUs are so desirable. But Vertev, they just do racks. They do hardware. It's not like, oh, we want to charge you twice as much for the racks. The customer would go to their competition and say, oh, we'll just go buy racks for somebody else. So they don't have that pricing power that NVIDIA has. When we get to margins, 70% margins, double the margins that we saw for Vertev. So when you sell $1 million of revenue from NVIDIA, they get to keep 70% of it as a gross margin. Vertev, not so much. Excuse me, my voice is getting a little dry from talking so much. Okay, so the gross margins are not perfect. They are expanding them because they're in high demand, so they can increase their price to a certain extent. That looks good. So this is $1.3 billion of free cash flow. So that's the first thing we're going to check. So 1.3, let's update that. So we'll go. And they're growing at 20%. So we'll give them the benefit of the doubt and say they're going to grow at 20%. All right, so we'll look at their cash and debt. I don't think they have much debt. We'll just take a look. So we have cash of 1.5, debt of 3.14. Okay. So based on cash, if I expect that the trailing 12 months is going to grow at 20% and it's going to grow at 20% for the next 4 years, the data center build out, it'd be a huge surprise if it lasts 5 years. After that, I expect they're just going to grow at 4%. And I think they're going to have a very good couple of years. It may end in a year, it may end in 2 years, 3 years, the whole build out and the big demand cycle. So that's the best cash flow I can put on this valuation for them. Now, this is, in my opinion, a higher risk stock because it's smaller cap, it's susceptible to this cyclical cycle. But even with that, I'm going to lower it to 9%. So it is smaller, but they have a decent balance sheet, just a little bit of debt. All right, earnings per share, 359. But what is the consensus on earnings per share? All right, the consensus, we have 15 analysts looking at it. And $3.60 is the consensus. And it's going to turn into $4.39 next year. So 360, they haven't reported. When are they going to report? July 30th, next week. So we're going to go with 360 since they haven't reported Q2, but probably in a quarter, I'd probably start using next year's earnings per share. So this is 360. Now, I shared my comments on they don't have a high margin business. They are growing. I'm not going to give them a crazy PE. If they had like 85% margins, maybe I would give them a 40 PE because they're margins, but it's a 36% margin business, gross margins, and they're growing at 20%. That's very good. 24 is good for a company like this. They're going to grow at like 20%. So overall, I think this stock's priced about 18% too high, and that's giving them a very, I'm going to call it optimistic, positive-minded valuation. This company is going to keep going up while the data center build out continues. But I've been through these cycles before, and I know that it's been a while, but the dot-com bubble or the internet build out is very similar to the AI build out. When you think about technology being deployed, like back in the internet build out, we were building out the internet, switches, fiber optic lines, all that good stuff. And you saw a peak and then a drop. I'll show you an interesting graph. The biggest beneficiary of the internet build out was Cisco. And this is what happened to Cisco. The price got really high and then it crashed down. And it's never gotten to its previous high that happened 25 years ago. That's what happens when these cyclical businesses get overheated and then they crash down. And there wasn't a lot of demand because it was built out. It was built considering the growth that they were going to need for like 5-10 years. So it just took a long time for this stock to ever work for investors. So that's an example. And you can look at Intel, suffered the same fate. I think that AI is having a similar journey where it's going to be built out. There's going to be a pausing of demand. A lot of these stocks are going to come down in price. And I feel like Vertev is going to be one of those stocks. In the meantime, the stock market's going to keep eating it up because the stock market loves the AI story. And if this is a stock that an investor was looking at making money for the next year and you feel like the stock's going to keep working, that's the thesis. That's the idea you have. Okay. If you're an investor like me, where could I see myself owning Vertev for the next 5 years and seeing this stock go from 137 to 500? No, I see that's not anywhere near my reality. My reality says it's priced too high. My reality looks at margins, 36%, not high enough. I'd rather own NVIDIA at that rate, rather own stocks that have really high margins. And that's Vertev. It's one of those stocks that's in the data center. It's like that football analogy. Who wouldn't want to be part of the Philadelphia Eagles? I'd love to be. But are you buying a stock that represents the equipment manager or the quarterback? Ask yourself that. You know, which company within that ecosystem of data center would you rather own? Well, NVIDIA, maybe even, Broadcom, or in my case, Alab. Alab is in that data center build out. And Alab's $20 billion. And Alab is growing at 200%. That's phenomenal. Hard to find 200% growers. They have a reason why they're growing like that. These guys do semiconductors that enable companies that have big workloads, like they have a workload at AWS, Amazon, big workload at Azure, Microsoft. And these big applications, big data platforms need to communicate with one another. You need fast connecting semiconductors or fast connections. That's what Alab does. This is a space that's growing really fast in that market. So they have a good story. And they have terrific margins. So this one's better in my book than Vertiv. It has a better story. It's growing 200%, 75% margins. That's why I like Alab and I don't like Vertiv. Yeah, this one's more like, this is not the quarterback, that's NVIDIA. This is a wide receiver that makes a lot of great catches. So Braden, I really appreciate this super chat. Consider being a paid member, man. You can ask for as many tickers as you'd like. I hope you found my analysis interesting. So thank you for asking and thanks for the sponsorship. I appreciate it. Please ask any questions you have on Vertiv. Michael Anthony, SMX. Big move today. What's SMX? Security matters. 89%. Jeez. Why? The Genius Act just launched a new economy. Security matters was already there. Ooh. Interesting. Who would have thought? Small cap. Before today, they were under $1 billion. No, I'm sorry. Is this market cap 1.48 million? So this is a tiny cap. Is that right? Am I reading this right? Like 1.48 million. So it went up 89%, but before that, they were less than $1 million in revenue. So this one is tiny. They don't make revenue yet. Okay. Well, whoever's in it's happy. So Braden, thanks so much for the comments, man. I'm glad that you get value from my analysis and you find my analysis interesting. That's why I have the channel, and it really picks me up to get comments like the one you just put. I appreciate it very much. All right, so that's SMX, $1.5 million market cap. Woohoo! Go SMX. All right, that was a cool stream, everybody. Thanks for tuning in. Really appreciate all the questions. I appreciate the super chat. Appreciate all the people that support the channel. Really appreciate it. I'm going to call it a day. You guys have a terrific weekend. Let's kind of get rested up because we're going to have another big week of earnings next week. I'll try to do some live streams after those big earnings. This week I was super busy, so I couldn't do it after the big earnings from Google and Tesla. But next week, hopefully on, I guess it'd be Wednesday and Thursday, I'll see if I can stream after the market closes and we can do kind of a watch party kind of approach, get the earnings real time and then review them and see what we think. So thanks so much, everybody. I hope you guys all have a nice weekend. Hope you made a lot of money this week, and let's get ready for next week. Take care, everyone.